There's a direct correlation to how much someone looks at their investments and how well their investments are going to grow. And it's a continuum, right? So on one end of the continuum, you have someone that's checking 20 times a day, and you know their investments are going to just do horrible. If you don't know that, they are. A lot of evidence over the decades very clearly show the more you check, the more you look, the more you trade your investments, the worse your money is going to grow. And then on the other end of that continuum is someone who never looks at it ever. And those two ends grow their money about the same. It's somewhere in the middle where you have some passiveness to it, but you also have some times where you have to be active that gets the best returns. But the problem is, it always feels so slow while you're looking, even if you look once a week, or even if you believe that some market is in a bull market, some assets in a bull market. If you look often, it feels very slow as the days go by. But then if you were to look at a price chart a year later and look back and go, well, yeah, I mean, of course that's what you would have done. And that's the lesser self. That's your lesser self, my lesser self, where we look at these short-term moves and it kind of makes us crazy. And that's why the best strategies are able to delete as much noise as possible while keeping those main signals as clear as possible. Now the problem is, what is causation, what is correlation? Meaning, what's the one thing that's causing something else, or are they just correlated? And so I want to talk about that a little bit this weekend with you about two major assets, or two of the major currencies on the planet, the biggest reserve currency, or the biggest fiat currency on the planet, and the biggest hard currency on the planet, because they are duking it out. Hey everybody, this is RC Peck, and this is my weekend podcast, and I am one podcast away from 333, so this is podcast 332, and I thought this was a great correlation or causation, a little cartoon. Everybody who went to the moon has eaten chicken. Good grief. Chicken makes you go to the moon. That would be one of those correlations that just doesn't make sense. Now, what I want to do is look at a possible causation or correlation, which is it, between the US dollar and gold. So with that, I want to look at a price chart of the US dollar. Now, if you look at the screen, you see about 4 years of the US dollar. You see a channel in 2013, 2014, and then you see a channel again the most recent 15 months. So what I first want to show is this fall right here. Now that fall right there, just to be clear, in the US dollar fell 5.4% during this fall. Now during that fall, gold went up 5.2%. So the reason this is positive is because every number you see on the screen here is going to be what gold did while the dollar fell. So the dollar fell here 5.4%, and gold went up 5.2%. So kind of a 1-to-1 ratio. One fell 1%, the other went up 1%. But then you had gold fall again. Now this time you had the US dollar fall again. Now this time the US dollar fell 6.2%, but gold went up 8.4%. So in that case, for every 1% that the US dollar fell, gold went up about 1.33%. So, a little different, but not much different. And then things get kind of weird. Here the US dollar fell in 2015. So the black line is the US dollar, and during that time period that this oval, orange oval, or maybe it's a gold color oval, the US dollar fell 6.2%. But this time gold fell too. So that correlation is all off. Back here, the dollar fell 1%. Gold, generally speaking, went up 1% and 1.33%. But then this one, they both fell. And then you finally have this one where the dollar again fell about 7%. But this time, every 1% the dollar fell, gold went up 3%. So clearly it acted different when the dollar corrected this time. Now it's still in this channel. The dollar is still in this channel, and this is what's called down here, if you can see the black line, that's called a false breakout, meaning it broke down out of the channel but then moved back up into the channel. But the takeaway here is the average fall over these four, the average US dollar fall over these four falls is about 6.25%. And the average gain over these is 8.5%. But clearly this is the dominant growth in gold, and this is one of the reasons why not only from looking at it from this point of view, but using the LTech gold strategy that I have, that this breakout has clearly looked different. And all of you that have access to LTech gold, you can clearly tell when the buy signal happened. So that's the first. That's the first kind of, is it correlation, is it causation? It's not perfect each time, but generally speaking, something clearly different happened the last time the US dollar fell. Okay, so the next thing I wanted to do was I wanted to just zoom in over the last 15 months, and instead of looking at the US dollar falling, what I wanted to do is what happens when the US dollar goes up. So here the US dollar went up, and it went up about 7%. Now during the exact same time period, gold fell almost 9%, 8.8% to be exact. And then the next time the dollar rallied, this time it rallied 6.7%. But look, it still stayed in its channel. And this time gold fell 9.8%. So it fell, a little worse than the previous one. Now we don't have another full bottom to top run, and I'm not saying it's going to go from the full bottom to the top, but what we have right now is this right here. Now this move up in the dollar is about a 3% move up, and during the same time period, the gold has fallen about 3%. Now to be exact, this move up is 2.9% for the US dollar, and gold has fallen 2.8%. So we have some causation right now where when one goes up, the other goes down. But clearly when the dollar fell right here, right, when it made that fall of 7% when I showed that on the other chart, the previous chart, gold just took off in a 3-to-1 ratio. So the question now is what's going to happen? Has gold had a different tune, and is it going to do something different? And so just for a second, what I want to do is I want to go back to this latest move where the US dollar fell 7%, but gold went up 21.5%. So every 1% the dollar fell, gold went up 3%. So if we look to a price chart of gold, and the screen you're looking at right now is a price chart of gold, one of the things that has jumped out to me that the last time the dollar corrected 7% while still staying in a channel, gold broke out. In fact, it broke above this downward sloping trend line. It broke above it, and it broke even above this 200 period moving average. So it has clearly acted different this time. Not only has it moved up much more relative to the dollar falling, but it has broken out of a downward sloping trend line, and it's broken above its 200 period moving average. So it's acting differently. The question is gold finally going into a correction? Meaning it's moved up 21.5% over this move. It could probably use a correction to digest some of this move. The question is, how much will it fall? Now the average move the dollar made was 7% higher. And during that average move higher, gold fell 9% for that move. So if that ratio stayed the same this time, and I'm not saying it is, but I'm having kind of fun with some what if here, that means we could have about another 6 percentage point drop in gold. And definitely if it started to bottom and act in a bottoming like formation, that would be a good time. First of all, it would probably scare the heck out of people after 3.5 years of gold falling, but that would actually be a very healthy move for gold to settle down, digest this big move. And visually it's not necessarily a big move, but emotionally it is, especially after gold just continuing to fall for 3.5 years. To have it break up and out above that downward sloping line is clearly saying that something has changed, and the ratios have changed too between the US dollar and gold. Okay, so what is the takeaway? So first of all, short term is always tenuous, meaning whenever anyone looks over the short term in real time, it's like, I'm right, I'm wrong, I'm right, I'm wrong. Okay, today I'm right. Okay, no, this afternoon I'm right. No, now this morning I'm wrong. And that's one of the reasons why you do not want to be looking at price charts or your positions multiple times a day or even every day. But what you want is actually to have a system set up that can track and trigger and alert you if something breaks above or below. And that way, that keeps your lesser self out of messing things up. And that's one of the things that my clients learn in not only in the training videos, but when they work one-on-one with me, is that just how much our lesser self can really hurt us. So, here are some questions. Is this gold's first correction? If the dollar is breaking up and back into its channel, it is very likely that this could be gold's first correction while, with this new breakout. And if it is, we could possibly see about a 9% correction, or almost about a 50% correction of what it has moved. Now there's a question mark there because this is about the future, and it's hard to forecast things, especially if they're in the future. The other thing, is the US dollar actually strengthening? That would be pretty interesting. All the major powers around the world need a cheaper currency to promote their exports. And I can tell you, with 6 quarters in a row of negative revenue growth for the S&P 500 and 2 quarters in a row of negative profit growth, I'm betting those S&P 500 companies want a cheaper dollar and not a stronger dollar. Though, if the dollar just stays in the channel, is it really, strengthening that much? So it's going to be very interesting to see what happens, and it's going to really impact a lot of portfolio construction going forward if, in fact, the dollar gets back into the channel. And then the question will be, what does gold do when the dollar is back in the channel? And then lastly, stocks really need to decide what to do. They really need to decide what to do. Are they going to break out of that 24-month 15% channel, or are they going to break down? And this is one of the longest periods that the S&P 500 has ever been in a channel this tight. This is very abnormal. It does happen, but on average it happens about every half century. About every 50 years we get a market like this, and we are in a market like it right now. And what that means is you're going to want to follow a strategy that is agnostic and doesn't really care which way the market moves. Those are things you're going to want, and you're going to want to have portfolios construction, meaning what is your portfolio? What are you investing in? And it can't just be a bunch of ticker symbols. That is not construction. That's buying a pick of the week or a pick of the month ticker symbol, and that does not work out. Hey guys, this is just another step in helping you protect your future and your portfolio. Until next time, this is RC Peck. Hey everybody, thanks so much for being here and being on the podcast. I love it. I am updating some stuff on my blog post or my blog site, so pretty soon we'll have a new layout, and please start spreading the word. I'm entering the 21st century with easier ways for you to spread the word and get this information out to other people. Thank you so much for being in my world, and I will speak with you guys soon. Take care.